Any profits made when redeeming mutual fund units are called capital gains. And once these gains have been realized, a capital gain tax needs to be paid on this. Now, the primary consideration in all debt fund taxation is the holding period or the time frame between the buying and selling of units. If this holding period is less than 3 years, then your profits are treated as short-term capital gains and are taxed as per your income tax slab, which can be as high as 30%. However, if the buy-sell range is 3 years or more than 3 years, then you have long-term capital gains which are then taxed at 20% and come with indexation benefits. It is this indexation benefit which can drive your tax even lower and can be the difference between paying 20% or as low as 1% on your long-term capital gains. In this video, we shall understand the concept of indexation, what it is, how it works, and most importantly, how can one use indexation to reduce taxes. Let's begin. The term indexation generally represents a system or technique used by governments and organizations to align prices and asset values to present conditions. In other words, think of indexation as an inflation adjuster that allows modifying the price of goods and services based on a predetermined index. This predetermined index can be anything, but mostly takes into account the prevailing economic conditions like inflation, cost of living, wages, input prices, and other macroeconomic factors. In the case of mutual funds, indexation is done by adjusting the purchase price of a unit. This adjustment is often aligned with the inflation rate that persisted between the time the mutual fund unit was bought and the time when it was sold. So as a formula, the indexed cost of acquisition is quite simply the purchase price multiplied by the index value in the year of sale divided by the index value in the year of acquisition. Now the question is, what are these index values? The index we are referring to here is the cost inflation index or the CII. The CII is a number that is notified by the Central Board of Direct Taxes and represents the general direction of prices, which in the case of India is generally upwards, thereby signaling the inflationary trend in the country. Now the CII is notified once every year and the updated index value and also the previous year's value can be found on the income tax website, whose URL is attached in the description of this video. More specifically, the CII is calculated as 75% of the average rise in the preceding year's consumer price index. So as a formula, 2021's CII equals 75% of the 2020 CPI. And while it's debatable why the CII is only 75% and not 100% of the CPI, the crux of the matter is that the cost inflation index helps investors across many asset categories to inflation adjust their capital gains, which then leads to a lower tax liability. Let's understand how indexation works, and let's do that with an example. So say you invested a sum of 10 lakh rupees in a debt mutual fund in January of 2011. And over the next 10 years, this investment has delivered an annual return of 8.2%, which means the 10 lakhs has grown to 22 lakhs as of March of 2021. You needed some money and consequently redeemed the units on the 20th of March and are curious to know what your tax liability will be when you file your returns. Now, before we look at indexation, let's see how the calculations might have been had there been no indexation. So your purchase price is 10 lakhs, the sale value is 22 lakhs, 22 minus 10 is 12 lakhs, which is the long-term capital gain from this transaction. 20% on 12 lakhs comes to 2.4 lakhs, and that's what you would have paid as taxes had indexation not been there. But thankfully, we do have the benefits of indexation, which means we need to now convert the initial purchase of 10 lakhs into an indexed purchase price. This is done by using that little formula we learned earlier in the video involving the sale year index and the purchase year index. Now, since the mutual fund units were purchased in January of 2011 and sold in March of 2021, we need to consider the cost inflation index of FY 2010-2011 and FY 2020-2021, which as per the index table comes to 167 and 301 respectively. We now apply these index values in a formula, which means it's 10 lakhs multiplied by 301 divided by 167, which gives us an indexed cost of acquisition of a little over 18 lakhs. Now, subtracting this indexed cost of acquisition, that is 18.02 lakhs from the sale price of 22 lakhs, gives us the long-term capital gain of 3.98 lakhs. Since tax is calculated at 20%, 20% of 3.98 lakhs comes to just 79,000 rupees, which is a lot lower than the 2.4 lakhs we would have paid had there been no indexation benefits. That's a saving of 67% in our tax bill. But more importantly, lower taxes means higher post-tax returns, which is the primary USP of indexation and what makes debt mutual funds very attractive, especially when we compare it with more traditional products like a fixed deposit, which do not offer indexation. In fact, the ability to claim indexation is one of the top reasons why investors in the highest income tax bracket of 30% prefer debt mutual funds over fixed deposits, especially if the investment horizon is greater than 3 years. Having said this, there is another smart technique that is almost always used by HNIs, and now we see more and more retail investors also employing it in a bid to lower their taxes. How this technique works starts with what we have learned so far. We explained earlier that the cost inflation index or CII is defined for each financial year, which also means that the CII will change between March and April of every year on account of the change in the financial year. This rule can be used to one's advantage and can be used to lower one's long-term capital gain taxes by managing the period of purchase and redemption properly. Let's understand this with an example. In fact, let's use our original example. So the investor had redeemed his debt funds towards the end of March. I think it was the 20th of March. Now, had the redemption not happened on the 20th and if the investor had waited a couple more weeks, then the sale would have happened in April, which means the sale would have happened in FY 2021-22. FY 21-22 means a CII of 317 would need to be applied, which means the taxes payable on long-term capital gains would have gone down even further to just 60,000 rupees, which would save the investor an additional 19,000 rupees in taxes. This way we can see how carefully managing the date of purchase and the date of sale can have a profound effect on the final taxes that one pays. And now that you know this, it should come as no surprise why most fixed maturity plans or FMPs are generally launched in the fourth quarter of a financial year, and that's entirely to take advantage of an additional year of taxation using the March-April technique. Indexation is an important and effective tool that softens your tax liability on long-term capital gains and plays a big part in improving the attractiveness of debt mutual funds. In fact, indexation is not limited to just debt funds and is also used to calculate the inflation-adjusted price of other assets like land, building, gold jewelry, etc., with the exception of direct equities and equity mutual funds where indexation does not apply. Like in the case of gold, the tax structure on long-term capital gains kicks in after 3 years of holding and is taxed at 20% plus indexation benefits. Similarly, on property, this 20% with indexation benefits tax structure is applied after 24 months of holding. But there are some additional terms and conditions which might get a little complicated, and hence we would highly suggest that you use the services of a qualified chartered accountant when dealing with property. However, there is no denying that the knowledge of indexation is very important for anyone who invests in debt mutual funds, and that it can significantly reduce one's tax liability, as we showed using some examples in this video. And with this, we come to the end of this presentation. If you like this video, don't forget to tap on the like button, subscribe to the ET Money YouTube channel, and share this video with your family and friends. Thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.